Alright, welcome back guys. Let's start with the remaining topics. Before the break we saw if you have any non-financial assets, how should you find the fair value of that, correct? Next, if you have a liability or if you have your own equity instruments, how should the fair value be determined? If you have equity instruments or if you have any liability, how the fair value should be assumed, okay? Or how you should find it out. For that I'll give you a chart. Actually theory is quite big. I'll just give you a chart, remember that chart, okay? And in fact draw that chart in the class now. We'll give the heading as fair value of liability and equity instruments. We'll call equity instruments as EI. First, check is quoted price available? Is quoted price available? If the answer to this is yes, then fair value is equal to quoted price. If the answer to this is no, there is no fair value available, then you have to check similar liability or equity instrument held as asset by another entity available. One moment. No means one moment. Actually I had to modify this. One moment, hang on. No, actually this should be slightly different. Okay, I've already written this portion, huh? Okay, actually here we should have written this. Okay, in that case what we have to do, okay, I'll just modify this. Okay, see if you can, otherwise you write however you feel like. This should come. I'm just modifying this chart, that's it. If it is no, then you have to check is similar liability or equity instrument held by another entity, held as asset by another entity available. You have to question this. If the answer to this is yes, then use that as fair value. Use that asset's fair value. The answer to this is no, then you have to do a valuation technique. That valuation technique will either be market approach valuation or income approach valuation. Okay, this is your chart. Alright, so they've given all this in words, okay? If you know this chart, that is good enough. Okay, can we quickly discuss this and move on? Okay, now we are trying to find out the fair value of a liability of equity shares. What standard assumes, okay, maybe we'll go on this. So let's say you're finding the equity shares ka fair value, or you're finding out your company ka debentures ka fair value. Debenture is a liability, equity shares is equity instrument. First you have to check is quoted price available. Meaning, if you are a listed company, your company will be listed on the stock exchanges. So its quoted price means what? The price listed on the listed stock exchange. Yes, no? So see if that is available. Okay, like shares, even debentures can be listed, no? See if you are a listed company and your company ka quoted price is available. If it is available, use that quoted price itself as fair value. Correct? Now, on whichever day you're finding the fair value of that asset or liability, go to the market, check its quoted price. That quoted price becomes your fair value. As simple as that. This is very easy. Correct? No? Suppose you feel, no, I'm not a listed company. I don't have any quoted price available. Then what it's saying is, check if similar liability or equity instrument held as asset by another entity available. Your company, let's say debentures, you're finding out the value of debentures. Or maybe let's take it as equity shares only. Your company equity shares you're valuing. That is not listed in the market. But you might have a similar company. Their company ka shares might be listed. If their company ka shares is listed, means it will be held by somebody as an asset. Asset ka fair value, you can find out. So they're saying use that asset's fair value. Basically what, in a way, what they're trying to say. If other similar companies are listed, means that listed price will become this asset's ka fair value, no? Use that itself as this particular liability ka fair value. What the standard assumes is, it's easy to find out the value of an asset than value of a liability, because assets are easily sold. Liabilities are assumed, they're not sold in the ordinary course of business. Yes or no? So check if those similar liabilities, for you it may be a liability, for the other guy who's holding it's an asset. If similar asset is held by other entity, you just check that other assets ka fair value you find out and use that as this liability ka fair value. That's what they're trying to say. Got it? If you feel no, similar asset is also not held by any company, you are a peculiar company, you don't have any similar industry, then you have your company is also not listed, neither do you have similar companies, correct? In that case, you have to do what? Valuation approach. You have to value that liability. And valuation approach for allowed is either market approach or income approach. These are valuation techniques which we'll discuss further. It'll come. Okay, that I'll tell you in a bit. Alright, we have a couple of problems also on this. We'll take it up there. Fine. So if nothing is available, you'll have to value it. And this is your two methods of valuation is available. One is market approach. Another one is income approach. Fine. Now, that we'll discuss. Put that on hold for the time being. Manage. Sorry, sir?
It's going to be used, which method we use is specified?
That is not specified. Either you can use both. Yeah? Or you can give equal weightage to both and do it. Okay. You normally do that, no? When you're valuing the company. Discounted cash flow and market approach. You give a weights and you do that. You can use a weighted approach and do it. Standard does not say anything. They said these two are permissible method. Whichever is best suited for you or whichever data is available for you. Accordingly do that. Or assign both to them and do a weighted average. That's fine. Alright, in one of the problems we'll see that they've used weighted average. We'll figure it out. Okay, so far? Okay, simple. So thumb rule is what? Or a simple workflow is what for this? If you're finding fair value of liability or equity instruments, first check is quoted price available. Quoted price under? Listed price available. If it is available, take that itself as fair value. Simple as that. Okay, logical also, correct? Now why you have to go somewhere else? When your company is only listed, you can use the quoted price. If you're an unlisted company, then what do? Okay, your company may not be listed, but there could be a similar company who might be listed. That similar company ka, like liabilities will be purchased by some guy as an asset. Yeah. Some investor would have purchased that. Correct? Yeah. Find out the fair value of that asset. Fair enough. Yes. And use that as this liability ka fair value. Easy to say, but in the problems anyway, they will give you all this data. I know. If you feel no, I don't have similar company also, then you have to find out the fair value with valuation technique. And two valuation technique are allowed. One is market approach. Another one is income approach. Fine. Now, that is what they are trying to say with all this. In words, we have put it in charts. Okay. Chart is good enough for the time. Remember the charts. Fine. Now. Okay. Next, there is a small concept which is not printed in your book. Write this down, sir. It's not typed. Okay. Just write this down. Fair value at initial recognition.
So there is a cost approach also valuation technique?
That will come. That is for assets, sir. For liability, in fact, it is not given. Valuation technique is a separate concept. Okay. But only for liability, only two approaches are allowed. Cost approach and income approach. There is another approach known as cost approach that is used only for non-financial assets. That is for assets, not for this. For this, only these two methods of valuation technique are allowed. Okay, this is a separate topic. Don't compare this and this. Okay, now fine. This is also there in your book in your study material. Okay, as in words. I've cut off words and I've given you in chart. Fine, now. Hope it's okay for you. Okay, for liability, only these two valuation techniques are allowed. Other than liability or equity instruments, there are in fact 3 valuation techniques. Cost approach, we will see when to use. Not for liability, definitely. Okay. One small concept is there. Write that down. It is not there in your book. I'll give you a couple of pointers for that. Fair value at initial recognition. This is one initial recognition of asset and liability, both. Initial recognition of both assets or liability. Common. Whenever it's a common word, it applies both for asset as well as for liabilities. I know. Okay. So have you heard this term known as transaction price, sir? Have you heard about this term somewhere? Transaction price? TP? Yes, no. Whole IND AS 9 we dealt with this, correct? No. In fact, you used to do also. Check whether the transaction is at market terms or off market terms, correct? So transaction price, can you tell me what is transaction price for asset, sir? What is transaction price is for asset? Purchase price to buy the asset, correct? No. Okay. So that means for asset, what is the transaction price? Amount paid, price paid to buy the asset? Price paid to buy the asset. And similarly, what is the transaction price for liability? Can I say price received to assume liability? Price received to assume liability, like bank loan, or maybe I'll write this and then I'll explain. Price received to assume liability. Like you took a bank loan of 10 lakh rupees. You are recognizing a liability because you received 10 lakh rupees cash. So 10 lakh rupees cash you received and you are assuming that liability, correct? No. Hence I've received price received to assume liability. Are we okay with this, sir? Yes. If you just check, transaction price is an entry price, correct? To buy the asset, to assume the liability. That means this is an entry point, correct? But fair value is the exit price we already wrote. Okay, so next we'll write what is a fair value. Fair value FV. What is FV ka? FV for asset is what, sir? Price received on sale. Fair value for asset is price received on sale of asset. Similarly, what is the fair value of liability? For liability, fair value is the price paid to transfer liability. Price paid to transfer liability. That means this is talking about sale and all. Sale and transfer. That means this is exit price. Transaction price is entry price. Fair value is exit price. Correct? But if you are buying means someone is selling. No? Correct? That's how it works. Yes. Normally what happens? Copying. Okay, finished off. Normally what happens, sir? When you enter into a transaction, transaction price and fair value are same because you enter into an arm's length transaction only, correct? No? Correct? But there could be some differences. There could be differences because if you are a related party. I just gave an example, iPen. Price was 5,000, but did I sell it to my cousin at 5,000 or 4,000? 4,000 is a transaction price, but its fair value is 5,000. There is a difference. There could be a difference between fair value and a transaction price. Normally they will not be, but under circumstance there could be some difference. If there is a difference, what to do is what this concept is all about. There is a difference between transaction and fair price, fair value and transaction price. How to account for it? Where should it go? Is what this concept. Got the concept down? So that is what I'm dictating few points about. So write the third point as normally TP is transaction price. Yeah. Transaction price and fair value will be same. Will be same. Transaction price and fair value could differ if it's a related party transaction. Could differ if related party transaction, or what? Stress sale. If you're doing any stress sale or force sale, correct? Then will you sell it at fair value, sir, or you may settle at even lower price also? Possible. That means in that stress wala sale, transaction price and fair value need not be same. They could differ. Okay. If transaction happens in a market, other than principal or most advantageous market. Normally you transact in what? Principal or most advantageous market, yes? But if you are transacting in any other market, then possible that transaction price and fair value could be different. Like, okay, copy, I'll give you an example. Okay. Let's say there is a wholesaler, sir. Wholesaler will deal in retail market or wholesale market only? Wholesale market only, because that's where his maximum volume will take place, correct? No? He could have various wholesale market. Among them, he'll choose one as what? Whichever is dealing in highest volume, that will become his principal market, correct? No? Or if there are many markets, he will choose what? If there are many wholesale markets, then he'll choose most advantageous market and find out the fair value. Possible? Let's say for a wholesaler, there is a wholesale market. And in that wholesale market, he normally sells a particular product for 100 rupees per unit. He's a wholesale dealer, and in that wholesale market, normally he sells the product for 100 rupees per unit. Got it? This time around, he entered into a retail market. He's selling it to a retailer. Okay. Sir, this 100 rupees per market is for a wholesale. That means you have to buy in bulk quantities. But in the retail market, normally you don't sell it in that much bulk. The quantity will be lesser. So he told the customer, I will give it at 150 rupees per unit. If you want, buy, otherwise go. Because you're buying only less quantities, correct? If you're buying more quantities, I will give you 100. But since you're buying less, I'll sell it at 150 rupees per unit. Customer said, no problem, give. Okay, so far? So normally you deal in what? Primary, principal market or most advantageous market. And in that, what is the fair value of that per unit? 100 rupees. Correct? So that means the fair value of this product is 100. Because you find out the fair value from principal market, no sir? Or most advantageous market. By going to the market, you found out that its fair value is 100. But did you enter into this transaction at 100 or you enter into this transaction at 150? That means what? Transaction price is 150, but fair value is only 100. So there is a difference. Why is there a difference? Because you are not transacting in principal or most advantageous market. You are transacting in another altogether a different market. That is retail market. So if you are transacting in any other market other than principal or most advantageous market, it is possible that fair value and transaction price could be different. That is an example. Easy now? Got it? Under these three circumstances or some circumstance, it could vary. If there is a difference, what to do? You should be telling me this. You have done this already. If TP or what should the difference? Difference between transaction price and fair value. What should happen? You have done this. IND AS 109. Staff loan. Or the very chart only we gave. The very thing, first accounting in IND AS 109 was what I used to tell. First check whether the transaction is happening at market terms or off market terms. You remember that case where what happened? We had given a staff loan at 5%. Correct. To employees, we gave it at 5%. Had I given this loan to somebody else other than employees, actual rate would have been 8%. That means 8% is effective interest rate, 5% is actual interest rate, correct? You used to do that. So there could be a difference between you used to find out the fair value in that case. Let's say the loan you gave it to employees 10 lakhs. But the fair value you could have found it out to be 12 lakhs, possible. The difference, what do you used to do in IND AS 109? The 2 lakhs used to recognize as prepaid expense, if you remember. And amortize that over the loan term. All this we have done, sir. I'm just recollecting. Yes. Yes. So that's what this saying is. If there is a difference between TP and fair value, normally the difference goes off to P&L. Normally the difference between these two goes to P&L. But if any IND AS gives a specific treatment, then you have to apply that specific treatment. Difference between fair value and transaction price normally goes off where? to P&L. Straight away you expense it off. No amortization. Straight away transfer to P&L. But if any IND AS comments that you have to do it in a certain way, then you have to do it in that way only. Like IND AS 109 said, in case of staff loan, what?
P&L over the...
P&L. And even security deposit also, we did the same thing. Security deposit was given at 0 interest rate, but market interest rate was 10%. You found out the fair value. The difference between that, what? You got some container, remember? So you treat that as a prepaid lease rental, you treated and amortized. Why you did all that? You didn't transfer to P&L, the difference. Because IND AS 109 said it should be recognized as a what? It should be amortized over the loan term. Yes, no? Because that IND AS 109 is talking about. If IND AS 109 says you have to do that, you have to do that only. If none of the IND AS is commenting, then difference between these goes to P&L. Got it? Difference between transaction price and fair value goes to P&L. Unless what? Other IND AS specifies any treatment. If any other IND AS is giving any other treatment, follow that. Otherwise, it goes off to P&L. Manageable. So you can give the example as what? Staff loan example in IND AS 109. Staff loan problem in IND AS 109. If you go back and check your notes, you'll be able to understand what I'm saying here. If you have a little difficulty. That staff loan difference you didn't transfer to P&L. You treat it as prepaid expense. And you amortized. That's what. I'm given that reference. You can go home and check. Manageable. Correct. That's it. So now in this concept, you know what to what did we learn through this concept? Are you still copying? Two more concepts here. That's it. Okay. And then we have a few problems and standard is over. A nice standard. Again, a good standard, I would say, from examination perspective, because no locha, no confusion. Remember it full marks. Don't remember it 0 marks. That is also a disadvantage. Okay. But high chances of getting scoring on all this. Whether it will come or not, even I don't know. I know. You tell me whether it came or not. We will cover whatever is there. Okay. So a quick summary of this. What did we learn from this? You're still writing, huh? No problem.
So here it says not to amortize but transfer to P&L.
Normally don't know amortization. Transfer it off to P&L. Okay, you do that only if other IND AS is silent. If other IND AS say something, do that only. Okay. Like IND AS 109, in case of staff loan, we amortize because there they said so. Correct? They have given a treatment for that. You follow that. No comment means transfer to P&L. No amortization. One shot may put it to P&L. Done, not done. Why not? Okay. Okay. This concept is what? If any standard requires that initially you have to recognize asset and liability at fair value, what to do? Okay. There could be a difference between transaction price and fair value. Yes, no? Because transaction price is more towards entry price oriented, and fair value is exit price oriented. Correct? But in most of the transaction, fair value and transaction price will be same. Because if you are buying means somebody is selling, it will happen at fair value only. But in few circumstances, they could be different. One is related party transaction. If there is any related party transaction or stress sale, or if you're transacting in a market other than the principal or most advantageous market, then there could be difference between this. If such a difference exists, then what you have to do? IND AS 113 says, fair value measurement says, transfer the difference to P&L. But if it also says, if other IND AS is giving any specific treatment, follow that. If only no other IND AS is commenting, means you transfer to P&L. That's all as a small concept. Easy now? Not much exam relevant, but still there. Okay. Okay, next coming back, we have last two concepts related to valuation techniques. Valuation techniques. I'll give you some points for valuation techniques. Write down. So maybe I'll erase this. But first I'll save. I'll write it here only. Give the heading in a notebook. I'll dictate something, sir. Write this down. I'll give you some points and I'll give you a chart. Okay. Easy for you to revise it, because in wordings it will be a little difficult. So valuation technique is the next concept. Valuation technique, VT. Point number 1. First of all, when will you go for valuation? Okay, or else let's go one step back. Now you know how to find out the fair value of liability and equity instruments.
Yes.
For fair value of liability and equity instruments, what does the standard say? Check if quoted market price is available. If it is, use that. If it is not available, check if similar liabilities or equity instruments is held by another person as for you it may be a liability, but the person who's holding for him it's an asset. Use that fair value of asset itself as fair value of liability and do the accounting. Yes. If both are unavailable, then you do valuation technique. Valuation technique, they told market approach or income approach you use only for liability or equity instruments. Okay. Then standard told if you have any non-financial assets, normally non-financial assets you don't sell, you use it. Hence they told take what? Highest and best possible use from market participants' perspective. Got it? Then what remains? Other assets. Liability fully covered. Non-financial assets covered. Correct? That means the only thing that is remaining is financial assets. For financial assets also same drama. If you have quoted market price, use that. If you have quoted market price of similar companies, use that. That also not available. Use valuation technique and find it. Got it? What are the things we need to keep in mind when we're doing valuation technique is what I'm about to dictate now. Now I think you've got a reasonable workflow as to what it is, what should be done. Other than valuation technique. Things are okay? Can I give
the part that we wrote, can we also write fair value of liability and equity and add the...
No, for assets we have another valuation technique. In this chart, where did you write that? Here. This valuation technique, these two valuation techniques are suggested only for liability. For asset, one more is there. Cost approach. So hence I don't want to bring an asset there. There is another method, sir. Other method allowed for assets, which is not allowed for liability. Okay, hence I didn't know. That is the difference, yes. And we don't talk about this. We slightly say it differently, yes. But anyway, that's that only. Yeah, you could say same. No problem. But one more method will come for asset. For financial assets. Non-financial asset, highest and best use only. Manageable, hence I'm dictating some points. Easy, I believe now? Or confusion is there?
Just collating everything.
Collating. Okay. Okay, no problem. You need some time, or you want me to reiterate to tell you something? Tell it once more.
Like different things we are following also. So
yes.
In one shot. So
that's simple. That's the reason we're giving you charts now. Non-financial assets, highest and best use. Only three things. Actually, there's not different things. For liability, you will follow this chart. Liability or equity instruments follow this chart. For non-financial assets, you follow best use, highest and best use. For financial assets, sir, you think logically, sir, if it's a financial asset, like investment and all, you're finding the fair value. The standard doesn't have to say, you tell me what you'll do. You have an investment, let's say you have an investment in Wipro, correct? Is that a financial asset for you?
Yeah.
Yes, you're finding its fair value. So what will you use? Obviously, first price is a quoted price, correct? Fine. In generally BSE, because BSE has highest volume, or that market, that exchange where it has highest volume. Right now, in India at least it is BSE. Okay. First preference is that. Suppose Wipro is unlisted company, then what you will do? You will check any similar companies are listed. Right? That could be Infosys.
Yeah.
If that is listed, means you can take that.
Yeah.
You may not take that and apply it completely. You may have to do some adjustments. Adjustments will come here. Okay, use that. Fair enough. That also not available. Your company is also not listed. You don't have a similar company listed. Also means you have to do some value. Find out its value using valuation techniques. Now, valuation techniques ka pointers I'm giving. There are three methods of valuation technique allowed for assets: market approach, income approach, and cost approach. Because asset you'll replace now. So replacement cost will become your fair value. That's one extra step. Liabilities will not replace. Hence you ask that question. Remember why cost approach is not allowed. Yeah. Liabilities you don't replace. So cost approach says use replacement cost as fair value. If you have a PP, at some point of time you will replace. The replacement cost becomes fair value under cost approach. That is applicable only for asset. Hence I didn't write cost approach here. That's all. In a way it is same. Correct? No. Yes, sir. Can I any more collation you require, or you want to write, or I can move on? Move on. Okay. Finished now? Valuation. Sorry?
Yeah.
Okay. Valuation technique. First. So if you have to value something, you require some data. That data we call it as input. Okay. Information and input. Because without information, if you are doing discounted cash flow method of valuation, you require earnings wala information, and you require discount factor wala information. That we call it as input. Okay. So first point is input, in bracket you can write information. And this is important, sir, from examination per se. What I'm about to dictate now, this one and the next topic can be asked. In fact, it has been asked also. Input / information is required for valuation technique. Is required for VT. IND AS 113 fair value measurement, and IND AS 113 says, and IND AS 113 fair value measurement specifies or says use maximum amount of observable data. Use maximum amount of observable inputs here, right? Not data. And minimum amount, actually just write maximum of, amount would be incorrect. Use maximum of observable inputs and minimum of unobservable inputs. Maximum of observable and minimum of unobservable inputs. Second point. That means now what do we need to know? What is observable inputs and what is unobservable? Observable inputs is equal to inputs developed by using market data. Inputs developed by using market data. Like EPS, discount factor, etc. Next point you can write unobservable inputs. Unobservable inputs is equal to inputs for whom market data is not available. Market data is not available. Market data is not available. Like earnings. Earnings for DCF method, can I say? For discounted cash flow method, we require earnings. So that earnings we can call it as is not available. Or in fact, one more point you can write. Inputs for whom market data is not available, but developed using entity's estimate. But developed using entity's best estimate. Developed using entity's best estimate. You can write valuation technique or methods. Methods you can write, or approach. There are 3 approaches allowed, sir, under valuation technique. For liability, only 2, correct? But for others, you can go for 3. One is market approach. Market approach. Under market approach, you can write use price of similar assets / liability. Use price of similar asset or liability. Under market, this is under market approach. Next you can write cost approach. If you're using cost approach to find out the fair value, then you will be using replacement cost. And right here, use a replacement cost. Replacement cost will be treated as a fair value, subject to certain adjustments. Last one will be your income approach. Income approach. Under income approach, you'll use present value of future earnings. Present value of future earnings. These are the three methods under valuation technique.
Can you show the top part?
Sure. This portion is, or maybe from the beginning I'll show. Oh, observable. Okay, correct. Is maximum amount of observable data and minimum of unobservable inputs. Fine now? Copying anything still or okay? Sure. Okay. Quickly we'll go over this. Sir, you're valuing. Why are you valuing? Quoted market price not available. It's not a non-financial asset. So you can't use highest and best use.
No.
Okay. So if it's a financial asset, correct? Quoted market price is not available for that company, nor similar company ka quoted price, that also is not available. Hence you're going for valuation technique, correct? No.
Yes.
And a valuation technique, you require certain information. That information we call it as inputs.
Yes.
What the standard says is you have to use a maximum of observable inputs, minimum of unobservable inputs. Observable input means those inputs for we have market data, like discount factor, correct? Or earnings per share. Normally when you're valuing the company, sometimes you use a price earning ratio. You remember? P method is one of the value. If P ratio is 10, what does it mean?
That means,
P ratio is 10 means for 1 rupee of earning, in industry mein they're ready to pay 10 rupees.
yes.
Let's say your earnings is 50 lakh rupees. For 1 rupee earning, market is ready to pay you 10 rupees. Correct? If your earning is 50 lakh rupees means your enterprise valuation will be 50 lakh into 10, 5 crore. How did you find that value of the company? You used a valuation technique. For that you used a particular input. What is the input you used? Price earning ratio. That price earning ratio is a market related data. That we call it as observable inputs. So if you're using any market related data, then we call it as observable inputs. If you're not using observable inputs, then we call it as unobservable inputs. Like when you're doing DCF method, you have to project the earnings. Whose earnings will you project? Some other company ka earnings or your own company ka earnings will project. Your own company. Can you match that with market data? No. So that is what unobservable inputs. Fair enough. IND AS 113 says if you have both, use maximum of observable and minimum of unobservable. Correct? No, because unobservable is entity specific one. But fair value measurement is always market specific activity. Hence they give the preference always to the observable inputs first. Manageable. Any other you want me to wait or I can move on? Okay, they've suggested 3 methods. One is market approach. Market approach we have already done, sir. Staff loan problem only. You gave staff loan at 5% interest rate, but market mein that loan ka interest is 8%. How did you find the fair value?
We found out here.
You found out the future cash flows. You discounted at what rate? At 8%. Correct? No. Why 8%? What is that 8%? That is the interest rate for similar instruments. So what you used there was market approach. That was a valuation technique which you used as market approach. That's it. Back then we didn't call it because we didn't know IND AS 113. Now when you go back and revise that topic, what you can write in Baju mein? Market approach valuation technique. You can give a tie out there. Getting it? So you're using similar assets or liability as an instrument and then you're finding the value of that instrument. That's how we found out staff loan ka value. Yes, no? If you want, you can write here again staff loan problem in IND AS 109. Staff loan question in IND AS 109. In financial instrument wala topic, we have done this question. This is what the way method in which you found out that value, fair value, is what we call it as market approach. Easy now? Yes. And market means similar only, no sir. Similar data you will use and find out the fair value. That's the only way in market. Yes. Next is cost approach. And a cost approach what? This is not applicable for liability. It's only applicable for, mostly it will be applied for non-financial assets. Correct? Because that cost has to be replaced. And a cost approach you have to use replacement cost. What will you replace? The assets. Which assets? Generally non-financial assets. Correct? No. Investments and all what sir? There's a chance of replacement or less? No. Yes. So generally we say use replacement cost. Use cost approach for non-financial assets. I know. Highest and best use. There is another valuation technique also. If you can't find out highest and best use, you can also use replacement cost. This is a valuation topic is a common for everything, sir. They have not specified valuation technique is for this only, that only. It's a common topic. If you are not able to figure out highest and best use, correct, then you can use valuation technique of replacement cost and also find out. Preference is that. Okay, this mostly valuation technique is a common one. Getting the difference or confusion aagta idea? Understanding. Okay. Last one is what? Last one is income approach. This you've been doing, no sir. Income approach means what? You'll find the income from that, correct? Basically. And but all that income will be in future. But you're finding the value now means what you have to do? Use a discount factor and find out this present value. So use present value of future earnings. That becomes your fair value. That's all. Easy na? Theoretical question can come, sir. Practically a little difficult, but theoretically they may ask all this. Explain valuation technique, 5 marks. You have to write all this. Okay? Little dry, but examination wise golden. Write this much, pakka 5. Or at least 4. Nothing less than that. Yes? So that way I consider this as a trump card. If at all they come. Any doubt? Okay, last concept is there, sir. Theory 1. After that we can go for problem. I know that it may be becoming a little too much as theory, but when it is there we have to do. We can't ignore any of it. Because 5 marks is quite too much in CA final to ignore. Correct? No? Even 1 mark may sometimes it decides the future. Correct? No? Many of us, your friends and all, you must have heard. 199. Correct? 197. How many of them have not got? Yes. So yes, all are important there. Because normally students have all this misconception. FR means problems I'll do. But concept mein, it's okay, I'll do later. That lethargy will come. To be honest with you, these are the concepts that actually help you clear the examination than the problems. Problems are fun to do. But problems, there could be a lot of twist and turn. One twist if you miss means go in the only. One clerical error means go in the only. But here, there is nothing like that. Clearly, you can estimate how much you will get also, you can tell. If you have written only 2 points, you can say, I'll only get 1 mark. But you can't say that with certainty when you are doing problems. Hence, I am not just, ignoring the theories or anything. We are doing everything. Alright, next last concept theoretical is hierarchy of, or you can write fair value hierarchy. Better that way, right? Fair value hierarchy. Fair value hierarchy. So just now you wrote you require certain inputs, no sir? For valuation technique. Those inputs are categorized into 3 things. Level 1, level 2, level 3. This also you have done in IND AS 109. If you go back, we did a chart for, or maybe what I'll do is, I'll draw the chart for you and then I'll give you IND AS 109 ka difference. If after this chapter, this one, if you go back and open IND AS 109 ka problem, you'll see this reference. In that time we didn't bother much, but here, now I think you'll be able to tie out. Okay, first, fair value hierarchy is, first point you can write, or you can write here only. There are 3 levels of input. And again, important from examination per se, sir. One question has already come from this. They'll give you a scenario and ask you which input is this. Level 1 now, level 2 now, level 3 now. That will be the question. For that, first we need to know what is level 1, level 2, level 3. That is what I'm giving you. There are 3 levels of inputs. 3 levels of input. Okay, first one is level 1 input. Level 1 input. Level input are, they are unadjusted quoted price of similar asset slash liability in active market. Each word is important. You have to write the same in case comes. Okay, no change. Unadjusted quoted price of similar asset or liability in the active market on the measurement date, on MD. On measurement date. That we call it as level 1 input. Second one, level 2 inputs. They are other than, they are observable inputs. They are observable inputs only, but other than level 1 inputs. They are observable inputs other than level 1 inputs, like quoted price of similar asset slash liability in active market. Quoted price of similar asset slash liability in active market. Point number B, quoted price of similar assets and liability, maybe we'll write quoted price of similar asset slash liability in inactive market. In inactive market. That is your level 2 inputs. Point number 3. First we'll write and then we'll discuss, okay? Level 3 inputs. Level 3 inputs. They are unobservable inputs. They are unobservable inputs. They are unobservable inputs. First one, you have to copy anything. And just showing everything again. Just see if you have to write anything, write it off. Okay. Can we spend a minute on this and see what is this? Okay. First one. So obviously for valuation technique we need inputs, correct? First input is level 1 input. Like in that example of Wipro we gave, we assumed Wipro is unlisted company. Then what do? We have to take similar company ka fair value. Yes, no, not similar company. We assumed as Wipro, or we assumed it as Infosys. Let's say Wipro ka fair value is 100 rupees. Or rather, one moment. We are trying to find out the fair value of Wipro ka shares. Since it was unlisted, we used fair value. We are trying to use the fair value of Infi, correct? No, Infosys. Let's say fair value of Infosys is 100 rupees. Organization concluded that Infosys and Wipro are similar to a great extent. We don't have to do any adjustment to this price. If this is 100 means our company ka fair value is also 100 only. If you can conclude that, then such an input we call it as level 1 input. Unadjusted, meaning you're not doing any adjustments from this 100. If this is 100 means yours also is 100 means you're not doing any adjustment, correct? No, you're taking other company ka quoted price, correct? And not doing any adjustments. Hence we wrote here what? Unadjusted quoted price of similar assets and liability in the active market on a particular date. You're taking other company ka quoted market price and not doing any adjustments. If you are doing that, then such an input we call it as level 1 inputs. Basically no adjustments. Take other company ka share as it is, or take other company ka fair value as it is and measure it. If you can conclude that, then we call it as level 1 inputs, which is pretty rare, correct? No, normally we do some adjustments. Yes. That means what? If you're taking Infosys ka share and doing some adjustments, like Infosys has 1 lakh as employee base. I have only 80,000. That means I can't take Infosys ka value as it is, correct? I have to do some my own adjustments, correct? Because they may have a more turnover than me. They may have more patents than me, more employee base than me, correct? So that means you'll have to probably do some slight change, slight adjustments you'll have to do. If you're doing that adjustments, then we call it as level 2 inputs. Okay. Or to give you another example. Okay. Let's say I'm trying to find out the fair value of my iPad. Okay. They released one iPad with yellow color. I got excited and I bought it at that time. It's not yellow color, I'm just saying. Okay. Yeah, let's say I bought a yellow color iPad. Okay. I'm using it for 20 months now. I've used this iPad, let's say for 20 months. I went into OLX because OLX is also an active market. For used goods and sell, normally we buy and sell in OLX. Correct? So I went to OLX and checked. Okay. For my similar, if I have for iPad similar to mine, what is the price they are quoting? I found out that in that OLX, my iPad in a similar range is quoting at 18,000 rupees. Fair enough. But I saw I read the features. All the guys who are selling iPad now at 18,000, their iPad is used for 18 months or lesser. But mine is used for 20 months. Correct? All those iPads are black in color. Mine is yellow in color, jaundice color. Okay. And third one, all those laptops which are quoted at 18,000 have extended warranty to them for 1 more year. Mine, I didn't buy only. I didn't buy any extended warranty. Now you tell me, can I say, okay, OLX mein 18,000 is a similar laptop iPad ka price. So my iPad ka price is also 18,000. Can I conclude like that or I have to do some adjustments? I have to do some adjustments. Many adjustments I have to do. Correct? No. Because their usage was 18 months. My usage is more than 20 months. Theirs is black in color. Mine is yellow in color. May not buy that only. Correct? No. And third one, they have extended warranty to them. I don't have. They are clean. Mine, all iPad, all there is scratches. Because I have used it left, right, center. Full job. Then we have to do some adjustments. If we are doing that adjustments, we are calling it as level 2 inputs. Input you are using from OLX market. OLX is an active market because there are more number of buyers and sellers. You took that, but you're not taking the price as it is. You're adjusting. Such adjustments we call it as level 2 inputs. Got it? If you don't adjust, we call it as level 1 input. If you're doing adjustments, we call it as level 2 inputs. Make sense? Okay. Active market, no? Active market means what? Large number of buyers and sellers. Active. It is active basically. But here they told one more point. What is that? Quoted price of similar assets and liability in inactive market. Andre Napa? There is no active market. Like Bombay Stock Exchange is an active market. Correct? Bangalore has also a stock exchange. Chennai also has a stock exchange. But they are not that active. Correct? They become your inactive market. So if you are using price, if you are, let's say you are taking Bombay May, it is not listed, correct? But there is a share which is listed in Bangalore Stock Exchange. If you are using that, what is it now? That is also quoted price for similar assets only, but it is listed in inactive market. Okay, now? So you can write an example here. BSC or NSC is an active market. BSC, NSC is equal to active market. But if you are using Bangalore, Hyderabad, Chennai market, then that will be what? Inactive market. Yes, no? Like that. That's all. There also it is traded, but at a lot lesser level. Like OLX, you'll have many other platforms also, no? Correct? But they are not that active enough. They don't have so many buyers and sellers. Correct? So OLX for second-hand goods will be considered as an active market. Any other platform which is relatively unknown could be treated as inactive market. So if you're using inactive market, you're still using market data only, no? Correct? That is known as what? You're using market data and observable also, but you're doing some adjustments or you're using inactive market. So those inputs will be referred to as level 2 wala inputs. Easy now?
If you are actually quoted price of similar asset means then I have to understand.
Sir, it's a simple thing. If you are using quoted price of similar companies and not doing any adjustments, level 1 input. You are using quoted price of similar assets in active market only, but you are doing adjustments. Like here, I can't take Infosys ka price as it is. I have to do some adjustments. If you are adjusting, then we call it as level 2 inputs. But you are using quoted price only, but you are not using quoted price in active market. You are using it in inactive market, means again level 2 inputs. Got it? So as simple as that. Anything other than level 1, level 2 is level 3 inputs, meaning unobservable inputs. We call it as level 3 inputs, like your discounted cash flow ka projected earnings. Correct? All those will be considered as level 3 inputs. That's all. They'll give you a question based on a case study. You have to categorize the inputs as level 1, level 2, level 3. I hope now it's okay for you. If you have to write it in one line if you want, or else what you can write. Unadjusted quoted price is what? Unadjusted quoted price in which market? Can I write AM or maybe inactive market? You are taking unadjusted quoted price in active market of that asset only, of similar assets, of similar assets and liability. If you are doing this, then we call it as what? Level 1 input, correct? No, you are taking unquoted price only, rather you're taking quoted price in active market, but you are adjusting. Or can I write like this? Adjusted quoted price in active market. We'll write active market as AM here, okay? In active market of similar assets and liability is equal to level 2 input. Okay, that. Or you're using price quoted in inactive market. Price of inactive market, correct? No? If you're using price of inactive market, then also it will be a level 2 inputs. Fine. So this is your summary if you want. Done? What is residue? If you're not using, all these are market driven, all these are market data. If you're not using market data at all, then it is unobservable inputs, which call it as level 3. Like discounted cash flow, you're projecting earnings, no? Earnings is it related? Can you match earnings with market data? Do you have any market data for it? No. Oh, sir, but in that we have discount factor. Yes, but which is the predominant factor there? Earnings or discount factor? Earnings rather is a dominant factor. Yes or no? If unobservable inputs are dominant, means it is always level 3 inputs. Fair enough. That's all, sir. It is okay now. Okay, so I think this is good enough for us. Now we have some 2-3 more questions. Can we take that up, or you need a minute to collate all this, or we will collate once everything what we learned, because the entire theory is over, or we'll do it in the charts. What do you want to do? We'll collate once, sir. You know, ಅರ್ಥ ಆಗ್ತಿಲ್ಲ ತುಂಬಾ ಕೊಯ್ತಾ ಇದೀರ ಅವಾಗಿಂದ. Okay, fine. No worries. Easy only, sir. Terms are little new, that's all. I don't think so. It's like that freaky as such. No problem. We'll give it. Okay. First of all, we saw some exclusions. Exclusion is what? You don't have to apply IND AS 113 fair value measurement for few components. One is share-based payment, lease transactions, and your impairment ka value in use. I know. And one disclosure exemption was given for plan assets. Because plan asset is not shown separately. They are netted off with the defined benefit obligation. That disclosure exemption, correct? Then we saw what is a fair value first of all. Meaning of fair value is what? Fair value is a price, correct? Received when you sell an asset, or price paid when you transfer a liability in an orderly transaction between market participants on a measurement date. So that means fair value is true only for that particular date, and it is an exit price, not entry price, correct? Now this is what we now decoded from the definition. Yes, no? All right. Next we saw if you have any restriction. We wrote fair value is an activity. You're finding fair value from entity specific or market participant perspective. Fair value is found out using market participant perspective. Hence market participant assumptions will be considered, but entity specific assumptions and all will not be considered, correct? No? And if you have any entity specific restrictions, sir, like that car example, you're using car only for 4 hours a day, not taking it outside city limits. That is entity specific restriction. In my iPad, I'm using iPad only to give class, to take only class, but anybody who buys an iPad from me can use it for any other purpose. That means all those are entity specific restriction, which will be ignored for fair value calculation. But if there is any asset specific restriction, you will take care of that. Asset specific restriction means like a whiteboard registered vehicle cannot be used for commercial purpose. That is asset specific restriction. That will be considered. Correct? No? Okay, that's what we learned in the second one. Then we went to unit of account. Unit of account means for what component are we finding the fair value? Whichever component you're finding the fair value, that we refer to as unit of account. Unit of account can be individual asset or liability, or it could be group of assets or liability in case of cash generating units. Correct? No? Okay. Next we learned the transaction. IND AS 113 assumes that the transaction, this particular transaction will take place in principal market.
market or most advantageous.
In the absence of principal market, only then we take most advantageous market. Yes, no? Principal market means those market which has high volume or highest volume market is principal market. Yes. Most advantageous market means that market which when you sell the asset you're going to get maximum price, or when you settle or when you transfer a liability you have to pay lowest amount. For selling you get the highest amount, selling the asset. For transferring the liability you have to pay the lowest amount. That which market has that, we treat that market as most advantageous market. Correct? No? Okay. Then we have a concept of what market participants will see later. Transaction cost and transportation cost. Okay. Transaction cost means what? Transaction cost is a characteristic of a transaction. It is not a characteristic of an asset or liability. Correct? Only if you enter into that transaction you will incur it. Correct? That means it's not really related to the asset. Fine. It only comes if you do the transaction. Hence, the transaction costs are ignored for fair value calculation. But transportation cost, however, is incurred to bring the asset from the current location to the principal market or most advantageous market. Correct? Since you are changing the location, characteristic of an asset will change. Because location wise usage also will differ. Correct? So transportation cost changes the characteristic of an asset. That means it goes hand in hand with the asset. Hence, the transportation cost should be considered for fair value calculation. Yes, no? This is what we learned. Next, what did we learn? If they give you multiple markets and they don't tell you which is principal market, then what do? You find that market which you will get maximum amount for asset. To get maximum amount, every expenditure should be considered. Meaning, transaction cost also, transaction cost also. Everything will be deducted and see which gives you the highest price. In our example, market B gave the highest price. Correct? So, market B will be designated as what? Most advantageous market, or in a way it is treated as principal market. Now, you have to go to that market and find the fair value. And for finding the fair value, still the same. Don't use any transaction cost. Only deduct transportation cost. Yes, sir. Okay. Then we went to market participants. Market participants mean those guys who are participating in that market. Meaning who are transacting in that market. Why is that necessary? Because fair value is always found out from market participant perspective. Correct? No? Yes. And market participants should act in their best economic interest. They'll act in their best economic interest provided they're independent, meaning they should not be related parties. 2, it should not be any stress sale or they should not be forced to enter into that transaction, and they should have reasonable access to that information. Now, these three circumstances, you could say they're acting in their best economic interest. Fine, no. Okay, then we looked at if you have any non-financial assets, then what we have to do? If you have any non-financial assets, then the fair value of such non-financial asset will be that asset ka highest and best use. But that highest and you need a minute? Okay, I'm just showing on the screen. You can just check. Highest and best use is from the what? Market participants viewpoint and not entity's viewpoint. Yes, but that highest and best use must be physically possible, legally permissible, and financially feasible. It should not be too costly. Correct? And physically also you should be able to take it, not beyond that point. Yes. And legally also you should have permission to do whatever activity that you want to do. Yes. Normally we assume what? Entity's usage is considered as best usage unless other data is available. Yes, no? Those are the pointers on that. Yes. Then we went to if you have any liability or entity's own equity instruments. If you have to find out the fair value of entity's equity shares or its liability, then what do? First, check if we have any quoted price. Quoted price on the stock exchange, if it is there. If it is there, means awesome. No? You don't have to look any further. Use that only as a fair value. If that is not available, then you just check. Okay, that is not there. At least what? Similar liability or equity shares ka price is available, which is held as an asset by some other party. Similar company ka. If that is there, means what? Then what do? Use that asset's fair value as what? Take that asset's fair value itself as fair value of liability and equity instruments. Yes, sir. If that is also not there, then last resort for you is doing valuation technique. Correct? Valuation technique for liability and equity instruments allowed is what? One is market approach, meaning similar asset liability approach, or income approach. Income approach means present value of future earnings. Correct? For you it's a liability, for some other guy it's an asset. Take that. Yeah, like that approach you do. Hence, Ind AS 113 says it's always easier to work out the fair value from the asset side. They have given it that. Valuation is same. Manageable. Okay, so next what did we go for? Yeah, one moment. Then we went for initial recognition. If any particular standard says you have to use fair value at initial recognition, then what? Then just check. There could be a difference between transaction price and fair value. Normally, there will not be a difference, correct? But in some circumstance, there could be difference. So circumstance could be in case of there is any transaction happening between related parties, or if it is a stress sale, or if transaction is happening in a market other than principal or most advantageous market, like wholesaler entering into a retail market. There could be a difference between TP and fair value, correct? If there is a difference, IND AS 113, what does it say? The difference you transfer to P&L, unless other standard gives any specific treatment. If any specific standard gives any specific treatment, if any standard says, like IND AS 109 says, difference don't transfer to P&L, amortize it, correct? Then what you have to do? Amortize it to P&L. And then amortize it over that duration, whatever the standard is specifying. Yes, no? Actually, this has one more point. I'll discuss that. Okay with this so far? Then you have a valuation technique. To do valuation technique, you require certain inputs or information. Those information, what IND AS 113 says is, if you have all kinds of inputs, use maximum of observable inputs. Why? Observable input means you can observe that data, or you can tie that data back in the market. Correct? So in fair value measurement is a market specific activity. Hence they say use maximum amount of observable inputs and a minimum of unobservable inputs. Correct? No, observable input means those data which have been developed by using market data, like price earnings ratio, EPS, discount factor, etc. etc. Correct? Unobservable inputs means what? Those inputs for which market data is not available, but it is estimated, it is developed by entity's best estimate, like earnings. When you find out present value of future earnings is of the company. There is no market data of that. Yes. So that is unobservable inputs. Got it? And three methods of valuation techniques is what? One is market approach. Market approach may we use similar assets like that staff loan, correct? Or you use cost approach. Under cost approach we use replacement cost. And under income approach we use present value of future earnings. Correct? No. And then there was a small fair value hierarchy. Fair value hierarchy means what? Which input are you using? Hierarchy of inputs. Level 1 now, level 2 or level 3 now. So there are three levels of inputs. Level 1, level 2, level 3. Level 1 means what now? Few things. Exact words you have to use. Unadjusted quoted price. First one is unadjusted quoted price of what? Similar assets and liability. Where? In active market. When? On measurement date. 5 things. Unadjusted quoted price of similar assets and liability, correct? In the active market on a particular measurement date. So if you are taking quoted market price as it is without any adjustments, then we say you are using level 1 inputs. Got it? And second one is level 2 inputs. Level 2 input means same. You are using what? Quoted price only of what? Similar assets only, correct? From where? Active market only, on a measurement date only. But you are not taking unadjusted. You are doing some adjustments, correct? No. That if you are doing any adjustments, then we call it as level 2 inputs. Or you are taking quoted markets of similar assets and liability not from active market but from inactive market. Yes, no. Like Bangalore Stock Exchange or Hyderabad Stock Exchange info if you are using. That is inactive market. That becomes your level 2 inputs. But still these are observable only. Why is it observable? Because these are market dates only. We didn't estimate this. We might have used Hyderabad Stock Exchange, but did we estimate Hyderabad Stock Exchange price? Did we estimate, or it is there? It is there. So it is observable inputs only. Correct? No. That's the reason we don't. Level 2, check the line. What did we write? They are observable inputs other than level 1 inputs. So even level 2 inputs are observable only, but they are other than level 1. Because in level 1 you don't do any adjustments. In level 2 you do some adjustments. Or you use inactive market wala information. Got it? If level 3 is what now? Unobservable inputs. Meaning there is no market data. We estimated and we are finding out. If you are doing that, means we say you are using level 3 inputs. Why this is important is, go back home and check IND AS 109 ka chart again. Which chart? Transaction is happening at market terms or off market terms. If the transaction is happening at off market terms, if transaction is happening at market price means what? If it is happening at market terms, fair value is equal to transaction price. No adjustments. If it is at off market terms, then we wrote a small chart. You have to check whether did you use level 1 inputs or level 2 inputs. If you are using actually level 1, level 2 inputs, you can be transferred to P&L right away. If you are using other than level 1 or level 2 inputs, you can't transfer it to P&L, you have to amortize. Staff loan was an example of level 3 inputs. Why? Earnings and all is entity driven. Future earnings you find out, no. Only discount factor you used market data. But earnings information was from the company only, no. Hence staff loan, that difference we didn't transfer to P&L right away, we amortized. Because IND AS says that only. IND AS 109 said that. If you are finding, if the differences between the fair value and transaction price is due to level 1 or level 2 inputs, that also says transfer to P&L right away. Only if it is due to level 3 inputs, IND AS 109 recommended, amortize it. Go back and check the chart, you'll find this. Back then, if I had told all this, it would have not gone into your head. So we kept it as it. We wrote it, but I didn't explain it much. Now, if you go back, I think you'll be able to tie it out. Fine, now? Any confusion? Hence, level 1, level 2, level 3 is important. Important for this standard as well as for other standards. They may combine this in other standards also. They may tell you. In fact, in IND AS 109 only they may give you. What is that? They may give you staff loan, and they may say the difference is due to level 1 input if they tell. And if you do that wala question like the way we have done, full marks 1. Because if it is level 1 input, you have to transfer the difference to P&L right away. So it has an importance. Fair enough. But back then it was not the time to discuss that because we didn't know what is level 1 and all. Correct? So now I think it's okay. Fine now. There it was level 3. No, level 3. Only don't worry about that. Fine now. What we have done is correct only. I'm saying hypothetically if they say that input is level 1 or level 2, you should have transferred to P&L right away. Manageable.
So this standard does not say that, no?
Which one? This standard does not say that. This standard in fact says what? The difference between fair value and the transaction price should be transferred to P&L right away. Yes, no, this standard says transfer to P&L right away. And it also says if any other standard is giving any specific treatment, use that. IND AS 109 said that. Level 1, level 2, level 3 wala drama. Got it? No. You can go back and check the chart. You'll find that. If it is not, let me know. I'll update it. I don't think so. But yes, anyways. Okay with this so far? This all is a theory, sir. Easy only, no? Correct? They have given all this here. Level inputs to valuation. We wrote already, no? We'll not refer this again. Can we go for questions now? Yeah. I think 1 is already done. Yeah. 2 is also already done. Third one? Question number 1 and 2 is done. Can we go for 3, sir? Yeah. Okay. Check. I'll read the question for you. ABC Limited acquired. Anything you're writing? Huh? Yeah. Okay. Finished. No problem. Okay. ABC Limited acquired 5% of equity shares of XYZ for 10 crore rupees. So this is the transaction price, sir. Alright. The company is in the process of preparing financial statements for the year ended 20X2 X3. We purchased it in X1 X2. Right now we are in X2 X3. And is assessing fair value at subsequent measurement of investment made. That means what? They want to value this investment at fair value. Okay. Based on the observable input. ABC Limited identified a similar nature of transaction in which PQR Limited acquired 20% shares of XYZ. That means, one moment. There is this company XYZ Limited. Okay. ABC Limited purchased how much? ABC Limited purchased 5% shares of XYZ, correct? Yeah. Now they are saying PQR Limited acquired 20%. Yeah. PQR Limited, they have acquired 20% shares in XYZ Limited. For about 60 crore they have acquired, sir. Are you able to get it? So they acquired for 60 crore. That means what? Which approach? This will be taken as base. Market approach. Correct? We're not using income, nor are we using cost. We're using market approach. So 60 crore if it is for 20%. For 5%, how much? Yes? Hang on. Yes or no? No. Straight away you can't do. Why? Sir, they've acquired 20%. With 20%, they get significant influence. Oh, yeah. But with 5%, you don't get significant influence. I mean, there could be some adjustments, no? So we'll see what that is. So straight away, don't do that calculation. The price of such transaction was determined on comparable companies method, CCM enterprise value. What they're saying is, enterprise value divided by EBITDA was 8. EBITDA stands for earnings before interest, tax, depreciation, amortization. Earnings before interest, tax, depreciation, amortization. That is EBITDA. So what they're saying is, enterprise value divided by EBITDA is 8. Correct? No? This is one market data. Based on this, they have found out the value of this 60 crores. So this is a market data, correct? No? This is like price earning ratio, sir. Okay, here enterprise value divided by EBITDA is 8. That means, can you say what is enterprise value? Enterprise value is 8 times EBITDA. If company earns an EBITDA of 1 rupee, the value of the company is 8 into 1, 8 rupees. Correct, like that? Let's see. So this is a market driven data. For the current year, EBITDA of XYZ, there is a company, is 40 crore. Nice, no? Current year, their EBITDA is 40 crore means their value will be how much? 8 times, correct? So 40 crore into 8, which is 320 crore is the value of this XYZ. Once you get the value, easy no sir, we own 5% of it. So 320 crore into 5%, straight away you get the value. Simple. Adjustment, we'll see, they'll give now. Yeah. At the time of acquisition, valuation was determined after considering 5% liquidity discount. Maybe this company is not listed company. They may be public company, but may not be listed. If it is not listed company, means how will you sell? You may buy the company shares easily. How will you get out? Exit ka restriction is there. That's what we call it as liquidity discount. Because if it is listed, easily I can sell it off. If it is not listed, it is difficult. It might be a little difficult for me to sell those company shares. Yes, no? So that they are saying, for that purpose, deduct 5%. Because higher the liquidity, higher will be the price. Yes, no, sir? So, but lower the liquidity, lower the price. Here they are saying there is a liquidity discount, meaning 5%. Find out the value, enterprise value you find out, correct? But 5% you have to deduct due to liquidity discount. Then 5% non-controlling stake discount. You own only 5%, no? Correct? So whatever value that you found out, correct? Enterprise value you will find. That is for taking over the company. But did you take over the company or you purchased only 5%? Only 5%. If you have controlling interest, you will get higher value. Suppose I have 40% interest in a company, or let's say I have 70% interest in a company. I want to sell it to you. In the market, its value is only 100 crore. That 60% or let's say that 70% value in the market is 100 crore. But I told I will sell it to you at 110 crore. Want to buy? Otherwise, no. What will you think? Okay, market value may be 100 crore, but this guy has 70%. If I buy 70% shares from him, I will have controlling interest of that company. For that controlling interest, you may not mind paying extra 10 crores to me. Yes? Correct? So, if you have controlling interest, higher the value. Do you have a controlling interest or just 5% value? For that, deduct 5% is what they are saying. Because you don't have controlling interest. You have only non-controlling interest. So, for that, deduct 5%. Totally 10% discount you deduct. That is their adjustments. And find out the value. What will be the fair value of entity's investment is what they are saying. A very, very easy question. Yes, no? Patapat mabarna. Okay. First, can we find out working note number 1, enterprise value?
No.
Or maybe we'll write the solution. Which question ka solution is this? 3 or 4? 3, yeah? Question number 3 ka solution, correct? No? Okay. First, working note, we have to find out enterprise value of which company? Enterprise value of that invested company. We have invested in XYZ, no? So enterprise value of XYZ Limited. Did they give the earnings of that company, sir?
Yes.
Earnings of XYZ Limited is how much?
40 crore.
In the current year, correct?
EBITDA is 40.
Because fair value measurement is only relevant for that date, no, sir? So we can't take previous year earnings and find out. You have to take current year earnings. How much is that value, sir? In fact, they gave EBITDA. Well, in fact, we have to use not earnings. We have to use EBITDA only, no? Because earnings could be anything. It could be EPS also. So we have to take the specific metrics. EBITDA. You want me to write the full form or it's okay? Earnings before interest, tax, depreciation, amortization. That is EBITDA. How much they have given? 40 crore. And they told what? Enterprise value. EV divided by EBITDA. How much EV divided by EBITDA, sir? They told 8.
Yeah.
Therefore, what? This is 1. This is 2, 3. Therefore, can I say enterprise value is equal to what? 8 times EBITDA or EBITDA? If your EBITDA is 40 crore, what will be your enterprise value? Therefore, enterprise value is equal to 8 into 40 crore, which will be 320 crores. That will be the value of this company, correct? But you don't have 100% of company, you own only 5%. Then means next is to find out the value of investment.
Yeah.
Point. You can write heading as subsequent. That's what they're doing. No, subsequent measurement. Subsequent measurement of XYZ investment.
Yeah. 1402.
This they've asked. No, this is a requirement, right? So we'll just write it as not working note, but like that only we'll get the heading. Subsequent measurement of investment.
Yeah.
In XYZ can I call? In XYZ Limited. Okay, for that. Particulars. Amount in crore, can I make it? Amount in crores. What is the enterprise value of the company, sir?
320 crores.
Enterprise valuation of XYZ Limited. Just now we found that to be 320 crores. I'll just write 320. Anyway, I've written crores here. But we own only 5%.
Yeah.
5% stake or value of 5% stake. Value of 5% stake held by ABC. ABC only, no? Or the other commerce? Yeah, ABC Limited. Yes. 320 crore is the total value, correct? For 100%. For 5%, how much? So 32, so 16 crore. Can we take 16 crore as a value and do it? No. There's some adjustments to be done. What is adjustment? Less. There are two discounts. What are the discounts they're saying? Liquidity discount and non-controlling stake discount. Can I add it anyway? Both are same. 5%, 5%. Both have to deduct from 16 only. Can we do it together?
No.
Sir, don't do it in one order. Okay, don't do like this. First calculate liquidity discount 5%. Then calculate this amount and then calculate 5% on that. No, it is not like that. It's not any order. Both are 5% on this value only. 16 crore only. Hence, we'll do it together so that the mistake can be sorted. Yes, no? Hope you got what I said. Liquidity discount and non-controlling NCI discount or NCI stake discount. What did they say?
Non-controlling stake.
NCI stake discount.
Yeah.
Both are 5%. So put together it is 10%.
Yeah.
So 10% into 16 crore. Value would have been 16 crore provided these two discounts were not there. Yes.
Yeah.
So since these two are there, you have to reduce it by 1.6. I mean 16 minus 1.6. That will be what? 14.4. That will be the fair value of the shares.
Yeah.
Fair value of the shares held by whom? Held by ABC Limited. Correct now? So this is the fair value you have to take for your calculation. Meaning in your balance sheet you will show this value. Correct now? That's it. Simple problem.
And any difference between the present whatever?
Any difference between that depends on the method you are following. You have to check this equity shares, no? Correct? You could be following FVOCI method or if you could be following FVTPL method.
Okay.
Subsequent measurement. Only for fair value you are taking Ind AS 113. Accounting and all still Ind AS 109 only. It's 5% discount, no? So it is a financial asset. If you had more than 20%, then you could have applied Ind AS 21, 27 and that said you can either follow cost method or fair value method. Since you are owning only 5% stake, this is still a financial asset for you. So Ind AS 109 gets triggered. And Ind AS 109 for equity shares, it will fail contractual cash flow test. So hence you have to follow either FVOCI method or FVTPL method. For FVOCI, it is irrevocable option. If you are using FVOCI method, then the difference between this and the current price will be transferred off to OCI.
Yeah.
And that OCI will never go to P&L. If you sell the investment, it will go only from OCI to directly to retained earnings. Like that. If you are following FVTPL method, then the difference between this 14.4 crore and existing value will be transferred off to P&L.
Yeah.
That is as per Ind AS 109, not here.
Yeah.
You're seeing they can easily combine this sort of questions. This with that. It goes aramse hand in hand. Yeah?
Yeah.
So instead has a liberty there. Hence, fair value measurement, the chance of separate question coming is pretty rare. Less, but if it comes, you should be lucky.
Okay.
Because straight marks, not much drama. So 3 is done. Yes, no? Can I go for question number 4? Any doubt is there or I'll go to question number 4?
You can go to question number 4.
Oh, the copying is also done, no?
Yes, sir.
Okay, question number 4. UK Limited is in the process of acquisition of shares of PT Limited as part of business reorganization plan. Okay, they're buying some shares. The projected free cash flow of PT Limited. Free cash flow means that cash flow which is available to pay to the creditors, that cash flow which is available to declare dividend, that cash flow which is available to the debenture holders, debt, that we call it as free cash flow.
Okay.
All the adjustments we'll do, like working capital changes, capital expenditure, all this we will do. Basically, operating cash flow, investing cash flows are adjusted. Financial items cash flow or financial components are yet to be adjusted.
Okay.
That is what we refer to as free cash flow. And now, you want a line for that or okay?
One line. So.
One line. Okay, write down. Free cash flow is equal to cash available to pay dividend and debts. Cash available to pay dividend and debts. All adjustments are done. Okay, but dividend related adjustment, debt related adjustment are not yet done.
Okay.
That is what we refer to as free cash flow.
Why debt also?
Because this is free cash flow when they use the term is amount available for investors. Investors include both equity investors as well as debt.
Okay.
That is a term. This is not accounting term, so it is a financial management term. Free cash flow. There they say free cash flow means that which is available for to be repaid to investors, or that money or that cash flow of the company which is available for investors. Investors include both what?
Okay.
Debt as well as equity. Yes, no? So that money available to them. Fine now?
Yeah.
Now can I proceed?
Yes.
So projected cash flow for the next 5 years they've given. Cash flows for each years they've given. I mean, what do you think they're going to ask now? Cash flows they've given. You find out the discount. I mean, you're using in a way income approach. Yeah. So terminal value they've given. Terminal value means?
Like finally we're going to get.
Finally we're going to get. Yes, no, normally everything will have some terminal value. Correct? Here, year on year you'll get this. Year 5, you're going to get the terminal value of 3965. Then they told weighted average cost of capital is 11%. This is your discount factor. They've given earnings and they've given discount factor. So find out the present value of that. Yes? Okay. The total debt on the measurement date is 1465 crore. And the surplus cash and cash equivalent is 106.14 crore. The number of shares of PT Limited on the measurement date is 8 crore 52 lakh 84,223. Find out the value per share using income approach. Okay. Can we do this as a solution?
Yeah.
Okay. First, you will take cash flow.
Yes.
Each year, same this data you will copy, whatever is given in the question. Check, have they copied the same 187.1, 187.6, 121.8. Yeah, all the thing they've copied.
Yes.
And terminal value you will get only at the end of year 5. Yes. All these are future cash flows.
Yes.
But under income approach, we require what? Present to value on the measurement date. For that, we require discount rate. Discount factor is going to be 11%. Yes, no?
Yeah.
So if you do 1 divided by 1.11, you're going to get 0.9009 and then 0.8, correct? No? 1, 2, like that you will get. Yes, no? So 5 years ka discount factor at 11% they've taken, sir. Okay, cash flow multiplied by discount factor will give you discounted cash flow. So how much will be that? 187.1 into 0.9090 if you do, you're going to get 168.56. Then 187.6 into 0.8116 will give you 152.26. Yes?
Yeah.
Like this you did and you got the cash flow, sir. Okay? And you added. You don't do like this. You present it in a normal table. Because here you have to add all this. Correct? No, this is terminal cash flow. This is not total. You don't present like this. You change the columns. It'll be easier. Fine, no?
Yeah.
Then when you total everything, you're going to get total discounted cash flow to be 3105.76. Okay, till here or any confusion is there?
No.
Okay, now one moment. If you need a minute, I'll give you, or I'll like to make some statements here.
Okay.
Yeah, sure. Okay, now. So discounted cash flow on the measurement date is 3105.76. A simple discounting. Cash flow you took, discount factor you took, and you found out discounted cash flow. Okay, one moment. What they gave in the problem? It is not earnings they gave. They gave what is a free cash flow. And what did we say is a free cash flow? Free cash flow means that cash flow which is available to be paid to investors.
Yeah.
And what did they ask you to find out the value, fair value of? Fair value of debt they asked, or fair value of equity shares they asked? Equity shares they have asked. Yes, no? Check here. Total number of equity shares. Determine the fair value per share. They're asking the fair value of the share, one share. Yes. Now you tell me, to the shareholders is 3105.76 available, or this 3176 is available both to the debt and equity shareholders? That means first you have to do what? If there is any debt obligation, first you have to reduce that. Then balance amount only will be available to equity shareholders. Correct to know? Observation. Is my statement right? Since this 3105.76 is available both to debt and equity, because it is a free cash flow, and we wrote what is the meaning of free cash flow. Yes. First, what you have to do, if you have any debt obligation, reduce that. Then the balance only will be available to equity shareholders. Correct? Check how much is the debt portion they have given there. Check. Total debt on the measurement date is 1465 crore. They have only given. So deduct 1465 crores from this. Now we're going to get how much is the cash flow. 3105.76 minus 1465. How much are you going to get? 1640.76. They also told in the problem we have some surplus cash. Since if debt is already, if debt guys are already considered, means this 106 is available now to equity shareholders only. To surplus cash means you will deduct or add? Add. So add 106.14 crore. Okay. So how much are you going to get? That will be 1746.90 crore. Yes, no? What is this? This is the equity value of PT Limited. Correct? No? Total equity share ka value of this company. But they asked the total value or per share ka value, sir? Per share. And they told how many shares are also there? This 1746.90 crore is a value for 8 crore 52 lakh 84,223 shares. So for one share, how much is the value? But here all the numbers you have represented in crores, no? So number of shares also don't write like this. Number of shares, what will you write? You have to write in crores. That means you will write 8.5284223. Yes. So 1746 crore is a value of 8.52 crore shares. So one share, how much is the value? 1746.90 divided by 8.5284223. How much will be that? 204.83. Not crore, sir. 204.83 crore is a value of one share. Correct. No, rupees. Yes. If you want that, you can write it outside also. Yeah. Are we comfortable with this? That's it. Over problem. A simple problem. Yes, no. We have one more.
Normally, when we say the free cash flows, it's free cash flows for shareholders, right? Why debt holders are included?
Free cash flow, the definition of free cash flow, if you just check, free cash flow is the amount available to pay dividend and debts to both. Free cash flow is for debts also. At least it is interpreted this way. Or maybe this is a management terminology, sir. Okay, but normally as per as my understanding goes, free cash flow is the amount available to both debt as well as equity shareholders. Fair enough. Take it like this only, at least in accounts wise. Fine. And as per my memory of financial knowledge goes, FM goes, free cash flow is both pertaining to equity as well as debt. Okay. Hence we'll do it like this only. No change. Easy? Okay. Anything else, sir? Can we go on for the next one? You are a senior, question number 5. You are a senior consultant in your firm and in the process of determining the value of KK Limited, one company ka value you are finding. You have determined the valuation of company by two approaches, market approach, income approach, and selected the highest as final value. You did both and you selected the final value. You did both, whichever was highest, you took that. However, based upon the discussion with your partner, you have been requested to assign equal weights to both the approaches and determine the fair value. You did the valuation already. Okay, you took the highest one. Your partner is saying what? Assign equal weightage to both. Correct? Whatever you get, that weighted average valuation you take as the value of the company. I know. They have given some data. Determine the fair value of KK. The details are as follows. Valuation as per market approach is 5268.8. Will you take this value or you will assign a weight of 50% for this? You will assign a weight of 50% of this and recompute. Yes, no? And value of income approach is 3235.2. Since you have to assign equal weights to both the methods, you will assign the weight as 50%, 50%. Assign the weight as 50% and find out the value. Correct? No. And you also have debt obligation. We just now learned whenever they give you debt obligation in these sort of problems, deduct it. Because it's a valuation of the whole company including debt, sir. Here. At least this problem is concerned. Yes. It's debatable. Fine. But here whenever they are using the word, at least here, it includes the values both for equity as well as debt. So debt obligation should always be deducted. I know. That means can you first tell me what is the value of the company? Under market approach it was 5268.2. You can't take this. You have to take only 50% of that. 5268.2 into 50% will be how much? So first value. Can I do it here only?
Yeah.
So value will be how much now? 2634.1.
Yes.
3235.2 into 50%. That will be 1617.6. Add the 2634. 2634.1. Yes, Bharatappa. 4251.7. What is this 4251.7? It is the enterprise value.
Yeah.
Are you also getting the same number?
Yeah. 47.
Okay. So you have debt obligation. What do you have to do for debt obligation? Reduce debt obligation as 1465.9.
Yeah.
Till now we have captured everything.
Yeah.
Let's read further. Anything else is there? We have some surplus cash it seems. So what do you have to do for that? Add 1.6. Add surplus cash.
Yeah.
That is 106.14. 106.14 is a surplus cash. Next, anything else is there? You have fair value of surplus assets also that you did not include. Correct? They have told. Specifically given means not included. Okay.
Yeah.
So fair value of surplus assets means what do you have to do, sir?
Add.
So fair value of surplus assets. How much is fair value of surplus assets? 312.4.
Yeah.
If you do this, what is the enterprise value you're getting now? Minus 4251.7 minus 1465.9 plus 106.14 plus 312.14. It will be 3204.08.
Yeah.
This is value of equity shareholders. Correct? They're also getting the same. 3204.08. That's okay. Round off. Small. This is the value of what? For all of the equity shares. Correct?
Yeah. Yeah.
You have to find out in fact, what did they ask? Determine the equity share value of KK Limited as in the measurement date. So they're asking for value of one equity share. And they told number of equity shares is 8,52,84,223.
Yeah.
So this is what all the numbers were in crores only, this one. So you have to divide by number of shares.
Yes.
So value of equity shares will be how much, sir?
3204.
3204.08 divided by number of equity shares was 8.52. How much? 52,84223. 84223. How much will be the valuation finally? 3204.08 divided by 8.5284223. That will be what? 375.69.
Yeah.
375.69 per share. Correct? No? That is the value of one equity shares. They also got the same number. Small round off is okay. 375.72. Easy. That's it. Simple questions. Doubtful such questions will come, but okay. Possible. Okay, yes, that's all. So, one moment. Anything you have to copy? No. I think we have one more additional question made is there. 1 second. Yeah, we have one additional questions. Question number 6. First part is homework. Why homework? Highest and best use, you remember?
Yeah.
For non-financial asset, that wala. Okay, or maybe quickly we'll discuss this off. Okay, or else why? DS Limited holds some vacant land which use is not yet determined. One company is holding. You're writing still, or okay, sir? Okay. There, one company is holding one vacant land. For what purpose to use that land, they've not found out. The land is situated in prominent area of the city where a lot of commercial complex are coming up. So that means looks like what? Highest and best use of that land is commercial complex. And there is no legal restriction to convert the land into commercial land. Legally also no problem. So it is what? Legally permissible. Because they told highest and best use should be physically possible, legally permissible, and financially feasible. So yeah, so that means here they have given that there is no legal restriction. The company is not interested in developing the land to commercial complex as it is not a business objective. Doesn't matter because fair value measurement is not entity specific activity. It is market participants activity. If market participants wants to do commercial complex, then commercial complex will be considered as highest and best use. Yes, no?
Yeah.
Currently, the land has been let out as parking for commercial complex around. We'll give it to you as parking. We made one shed probably and told use it as parking. So that means current use is parking lot. Can I say parking lot is the highest benefit, highest use of this land? No way. Yes. So next we will see. The company has classified the above property as investment property because they have let it out. So they have classified as IP. It has approached you, an expert in valuation. To obtain fair value of the land for the purpose of disclosure of IND AS. Because if you have investment property, IND AS 40 said no. Fair value should be disclosed. Unless that investment property is under construction phase. Then they told fair value is fine. But for a developed asset, fair value should always be disclosed. So hence they approached you to find out the fair value. On what basis land will be fair value? First, what will you write? For non-financial assets, fair value is what? Highest and best use. Correct? And that highest and best use is from market participant perspective. It should be financially what? Physically possible, legally permissible, financially feasible. These three. Point number 4, what will you write? In the current case, land is used for parking lot. But highest and best use for that land could also be used for commercial complex. So in the present case, highest and best use is a commercial complex. Yes, no? Parking lot ka income will always be lesser than commercial complex. No, sir? Hence, highest and best use is what? The commercial complex. Okay. So fair value will be determined based on that. That's what they've given here. Check. Therefore, the fair value of the land is a price that would have been received when sold to a market participant who is interested in developing commercial complex. Fine. So these three we have put it in bold. No, you can write that in examination. First 3 points, whatever we have written in our class note, same thing will be given. Okay. Other things, I think this you can manage. Yes, no? Easy? Okay. So that part is okay. Can I go for the second part? DS Limited holds equity shares of private company. In order to determine the equity shares, so it is a financial asset or non-financial asset? It is a financial asset. So don't bring in highest and best possible use concept here. For normal equity shares is a what? Quoted price is there, means take quoted price or take similar price or valuation technique. Let's see what it is. In order to determine the fair value of the share, company has used a discounted cash flow method. There itself lost. So when you're using discounted cash flow method, you have to take earnings as a base. For earnings, do you have a market data or it is unobservable input? Since you're using substantial unobservable input, it is what? Level 3 inputs. Got it? As there were no similar shares available in the market. Similar shares were not available, hence we used earnings approach. There itself, they'll ask now, which input? You know the input, which is what? Level 3. So there itself, we can write level 3. Okay, next. Under which fair value hierarchy will the above inputs be classified? Obviously, level 3. Correct, no? First answer. But you can't write a level 3 and leave it. 6 mark. Go in the audit. What you have to write? First, you have to write what is level 1 input. Then you have to write what is level 2 input. Then you have to write what is level 3 input. Then you have to say earnings is unobservable data. Hence, it is level 3 inputs. Got it? Like that. Hence, I gave you the theory. I know. Otherwise, even I could have done. I could have ignored all that. I could have taken this problem only and I would have explained that concept. But if you write like that, you will never get full marks. Though you are right, but only 1 mark. That will not serve our purpose. Service must, we should know the knowledge also and at the same time clear our exam also. That is also very important. No, knowledge at least we can get it later also if you want. Even though if you're not getting from me at least, later on you can get it. Correct? But more importantly, we should clear. Yes, no. So emphasis is more on the exam also. Yeah? What, sir? Sorry, sir?
With knowledge also no point.
Otherwise he's saying without knowledge also no point, sir. Yeah, correct. At this point of time, the priority is exam also. Correct? Yes, simultaneously we'll try to gain knowledge also. Not that we'll ignore that. But not at the cost of exam, for sure. So this is that. So you know how to write that. Correct? Now I've given you the theory for level 1. So write the theory, then write a conclusion that this is a level 3 input. Solution is anyway given also. Can I go for the next? Will your answer be, what will be your answer if quoted price of similar companies were available and can be used for fair value of share? If quoted price is available means now we have to check whether it is unadjusted quoted price can we do or adjusted quoted price. If it is unadjusted, level 1. Adjusted means level 2. That's what you have to write. Okay. So I can give a small line here. Quoted price of similar company available andre. Quoted price of similar company available. Then what you have to check? Whether it is unadjusted or adjusted. Correct? No? Unadjusted price or adjusted price.
So adjusting not adjusting is company
Yeah. Matlab, you'll have to give a disclosure of it. How, on what basis can you say that you can take an unadjusted one? Because whenever you're using similar company ka price, it is very hypothetical that you'll use unadjusted one. Because unadjusted means more or less it should be same, sir. Which will not be the case. There will be differences. Maybe similar companies, but they'll always have few things more than you or lesser than you, correct? So adjustments would be required. And most probably it will come under level 2. Hence even your answer is given under level 2 perspective only. But I wouldn't suggest write like that. I would suggest you write it like this better. So quoted price available. First you have to do whether it is an unadjusted price or adjusted price. Yes. If it is unadjusted price, then what you will consider this as? Level 1 input. Or else you will consider this as level 2 inputs. Yes, no? Write like this. Either as a chart or in words. Fine now. They have given the answer as level 2. I wouldn't suggest you to do that. Write the both. Fine. Easy. That's it, sir. All the questions on fair value measurement is also done. Chapter is over.